So Algonquin Power and Utilities has cut their dividend by 40%. Aritzia had some fantastic earnings, and Tesla has some price cuts. In this update, I'll be going through all that news, and I'll also be going through my buys and sells in my dividend portfolio. So if you want to follow along from week to week, if you want to start from the beginning, you can like the video, you can subscribe to the channel so you don't miss any updates. And with that, let's roll the intro. And with the TFSA in the last week, we're up 3%. So the market is recovering a little bit. And the past year, we're down 10% or down $2,000. And all time, we're down 5% or down $949. So you can see from week to week that the portfolio value can change wildly. You know, you can swing 3-5% in just a single week. That's why I'm not taking this to heart, and just knowing that, the market's going to go up and down all the time. It's a long journey, and you shouldn't be detracted by, a single day or single week. In terms of, years or decades from now, this is just a blip. You won't even see this on a chart. So just maintain a long-term focus. And the fact that I am collecting dividends from my companies means that I'm not reliant on selling my shares for a higher price later down the line. I'm not relying on that. So that's one thing I love about dividend investing. So getting to it, Algonquin Power is down even more since their last Investor Day presentation. So there is some bad news for dividend investors that we got the dividend reduced by 40%. So this makes me sad as a dividend investor, as this dividend cut lost me about $2 a month in passive income. So that sucks clearly, but the company does need to refocus on its balance sheet and protect the health and long-term stability of the company. And with this cut, they're going to rebalance their balance sheet. So they're going to attack the variable rate debt, which is one thing that I do agree with. They really do need to attack that. They should have a majority of their debts being fixed rate, because as we can see, the variable rate debt not working out in a high interest rate environment where the Bank of Canada just continues increasing interest rates and lowering the profitability and hurting the ability of the company to borrow money to grow the business further into the future. So they stated that with the cut on the previous earnings call from the Investor Day presentation, that they're at about a 75% payout ratio, but they do plan to raise dividends as the net income grows to allow that. So there is a possibility that the dividend will come back and grow slowly back to the previous levels. Hopefully, a bit healthier, so they don't have to do a dividend cut again. Obviously, not too great for investors, especially income-focused investors. So this is the danger of having a single stock, and why I would probably recommend, if you are newer, to just invest in ETFs, because you're not going to have wild swings and have your holdings go down 50%, if you're investing in a normal ETF. And they're going to be selling $1 billion in assets to help pay down variable rate debt. So they're going to be at about 80% fixed rate debt after the Kentucky Power acquisition. And they stated that they have a goal to maintain 85% of long-term debt at fixed rates. So that's pretty healthy. Only, a small portion of the debt will be at the variable rate, which is good, because if the rates go up any higher, it really does impact this business and this industry as a whole. So I've made a decision based on what I'm going to do. I won't be investing too heavily into AQN because management needs to execute perfectly going forward and make decisions that will benefit the business and the shareholder. So in the meantime, I'll continue reinvesting the dividend into this company, but I need to see a few more earnings reports before I'm confident deploying large amounts of capital into the stock. Moving along, we also purchased one more share of Alimentation Kushtar. So they're performing very well in this market, and they are starting to bring in charging stations into the US and Canada. So just starting to show you the the things that they can do into the future. They already have like these EV charging stations in Europe. Now they're starting to bring them in Canada. So pretty exciting news with this convenience store chain that is worldwide. With Aritzia, there were very good earnings, but there are some things investors did not like about them. And the stock went down from the 50s down to 45. So in Aritzia's latest earnings report, they had some good news and a little bit of bad, a little bit of concerning things in the earnings report. But top line revenue wasn't one of them, so that increased 37.8% to $624.6 million. The United States revenue increased 57.8%, which is, that's very, very incredible growth rate. And now the U.S. revenue is totaling 50% of their total revenues. So the majority of their revenue is now coming from the United States, and that's where they really plan to grow the company, expand it into the future. So things are looking very well for their U.S. expansion plans. The e-commerce revenue also increased 36.1%. So even their online e-commerce where, they ship to your home or you can prepare your order and then pick up in store is growing at a very, very good rate. And the e-commerce business comprises about 1/3, almost a third of their sales. So this is definitely an avenue that I'm very happy that, they're going along, they're using technology, they're trying to stay current and on top of things as technology changes. So it's really good that they have their e-commerce down and their U.S. based revenue is doing very, very well. The gross profit margin did decrease, so it went from 43% to 46%. So a bit of a decrease in the profit margin, but that is due to a combination of higher employee costs. So they have to pay employees more, and they definitely want to retain employees. So that's one thing they kind of have to do to retain talent, and keeping people in retail is fairly hard because that is a very, very high churn rate, and people burn out of retail jobs rather easily. So, and also they in a previous earnings call, Jennifer Wong, the CEO, stated that she doesn't want to increase pricing to pass on to customers as she wants to grow the brand. So rather than trying to make as much profit as possible on a one-time purchase, she wants a customer that will continuously purchase pieces from Aritzia over time. So that shows to me a forward-thinking CEO and trying to create a customer connection and customer loyalty. Rather than just making one sale and then that's basically it. They never come back to Aritzia because the value isn't there, or just the fact that that one piece was just so expensive that you think twice about buying another. And she also addressed in the recent earnings call that they just had that they're looking to increase pricing of certain pieces, but they want to be very careful about doing so. Investors are also scared off by the high inventory levels, but if you have been listening to their earnings calls, they didn't want to have low inventory levels like the previous year, and they were hedging around the uncertain supply chain issues of the previous year. And they do state that most of the inventory are customer favorites, so they're proven sellers that they have no worries about selling. And they don't foresee an increase in markdown items, which just means that they expect to sell the majority of the merchandise that's in their current inventory at the full price. If we look at another company like Nike, they also had some very high inventory concerns in a prior quarter, but in the most recent earnings of Nike, they had record sales. So I'm not worried about Aritzia and their inventory levels. I know it's just temporary, and it was a strategic decision to really ramp up the inventory, just in case we hit another snag in the supply chain unexpectedly. So that's just, planning around the future. And I'm not worried about Aritzia at all, and it should continue to grow very strongly into the future. I also purchased one more share of BN, so trying to increase my position in Brookfield. Moving along, I also purchased 3 shares of ENS, so we went from 74 up to 77 shares. So now ENS is paying us a dividend yield of over $10 a month. So it's a nice little milestone. I'd like to get all my stocks up to these levels going forward. I purchased 2 more shares of ETHY. So we just use Shakepay. So every time I have $5, I sell it, and then I buy this ETF. And then this pays me a yield every month for just owning Ethereum. So this is a way to make a yield off cryptocurrency rather than just having it sit there and do nothing, which I'm not a fan of at all. H-Yield, we purchased another 2 shares using our dividend, which was a little over $27. So we drew up 2 more shares. So in the next month, our dividend income is going to increase by another 28 cents a month. So that's awesome. We're just doing that, going with this ETF going forward. So this is our kind of S&P 500 alternative, which is just focused on a high yield, paying nearly 14% yield right now, just due to the market collapsing. Now it's a little under 14, but still a very good yield. With Microsoft, I've purchased about 10% of a share. So I just really like what they're doing with ChatGPT. So if you're not aware of what that is, that's, an AI that can, answer questions very simply. Or, you type in a recipe or you type in ingredients, it'll list you off a recipe you can do with those ingredients. So it can just answer questions directly, and they're going to integrate it into Microsoft Word, Windows, and even their Bing browser. I know nobody uses it because everybody uses Google Chrome, but who knows, maybe in the future that will change. So they're planning to roll that out in March, I believe. So we're going to see if that starts to threaten Google's dominance on search. I don't think it'll endanger YouTube, but Google should take it seriously and really focus on their own AI capabilities, because Microsoft is, definitely threatening there. It's very surprising that they would come out and start to become, a front runner in the AI race and just implement that into every Windows product and service. So that's just the power of Microsoft, that they can make small investments like this. They only put $1 billion into this company, and they're letting it grow with Microsoft Azure, their cloud service, and now they're putting another $10 billion into that company, OpenAI. So we're going to see how that turns out into the future, and I'm definitely far more confident in my Microsoft investment going forward than my Google investment, just because Google may actually have some competition for search. And then I also purchased 1 more share of Smart Center, so we went up to 38 shares. And with Telus, I did a buy of 6 shares. So in my previous video, my first video of the year, I said that I wanted to double my Telus position. So we're starting to get that underway. And if I purchase about 4 shares a month of Telus, I should be able to hit that goal. It would in 10 months probably, because that'll be about 40 shares. And this company is just rolling along, and it's actually kind of climbing out of the dip that it's been in. So definitely glad that I made my purchases while the price was down by 5-6%. Telus has not dipped too often, and I want to take advantage when it does. And for Tesla, I bought 1 more share of Tesla, so we did average down into that position, and they announced some pretty major price cuts in the US and Canada, and this is actually going to increase their sales a lot, because now a lot of their lineup will actually qualify for EV tax credits where they didn't before. So that's kind of the power of Tesla, in that the car business is very competitive. It's pretty brutal, but Tesla can lower their prices and still maintain a profit margin, whereas the other auto companies, if they were to lower their prices on their vehicles or do a price cut, they would go down to little or no margin and basically be operating break even or even at a loss. So Tesla has the power of margin, kind of in a similar way you can think about Amazon, about how Amazon can sell things at a loss just to destroy a competitor and completely take over an industry. whether it be diapers or whatever else they want to sell. Tesla has that capability as well, so not worried about it at all, and I'm going to be buying more of this company just because I realize how difficult and brutal the car industry is, and that Tesla has margin power over all the other car makers. And with the passive income update since the last one, we're up to $1,068.11 in total dividends earned all time. Our annual dividends increased by $2 to $949.06. The monthly average only went up slightly from $78.92 to $79.09 despite all of our buys, just due to that $2 dividend cut from AQN. So we would have been over $81, but that's just the nature of things, and can't really control what our companies are going to do, unfortunately. So made a kind of a mistake into AQN, so we're paying the price for that, but hopefully over time they can turn that around, increase the dividend over time. Weekly we went up slightly to 4 cents. On the daily we're up by 1 cent a day. Months to earn $100 is how I track the dividend snowball compounding effect, and that it just tracks the time it takes to make $100, so slightly less than the previous update. We're still working towards our goals, and hopefully we just have dividend raises rather than dividend cuts going forward. And if you haven't signed up for WealthSimple yet, feel free to use my link in the description below. If you use that link, you'll help support the channel, and you will have a chance to receive up to $3,000 in cash towards any stock you want. And have a great day, everybody, and let me know in the comments below if you're invested in AQN and what you think about the dividend cut, and if you're gonna buy it, if you're gonna hold it, if you're gonna sell it, or if you're not gonna buy it, let me know. Have a good day.